Welcome, YouTube family. Welcome to another edition of the Kevin Strong Show. And in this video, we're going to talk about the banking crisis. I'm going to go over some things showing how certain companies, specifically financial institutions, have closed a lot of their branches in 2021. I'm going to also talk about how when you make a deposit into your bank, it's no longer your money. A lot of people didn't know that. And finally, last but not least, we're going to talk about the infamous, and some of you may not have heard of this, bail-in. Very, very scary, but it's actually legal and it's been on the books since 2008. So if you're interested in that information, please stick around to the end of this video. I'm quite sure you will find it enlightening and definitely should make you take some action about how to protect your money. So without further ado, let's get into the news. First of all, we're going to start off talking about how American banks are closing most of their branches here. Let me go ahead and switch my screen and see here. All right, here we go. So like I said, the title of this article, it's very recent. It's February of 2022, February 7th. This American bank is closing the most branches. So that's the title of this, right? Bank tellers have started to become a thing of the past. Years ago, cash machines became the process of replacing them. And I've talked about this online and other platforms, how automation is replacing some of these jobs. Now, when this first came out back in, let's say, March of 2020, when the health crisis came about, they told us that, money could, pass the virus along. So you don't really want to touch that. Money is dirty. And for public safety concerns, we're really going to limit the access that the average American has inside of a financial institution to conduct a transaction. As we move forward almost 2 years past that point, as you've noticed, not only have there been a lot of branches closing, but what you're also noticing that those that are open have some type of restriction on how soon you can get into the bank. A lot of them won't just let you walk in. Some do, a lot won't. You have to make an appointment, and God forbid that you want to withdraw a decent amount or a large amount of money. They'll tell you have to make an appointment, or they don't have that much cash on hand. Now, just for those of you who may not know this, just as a little bit of a factoid, there's only approximately about 1.6 to 1.8 trillion physical dollars that are in circulation throughout the whole world. Everything else is just digital, or they create it on a screen. So in theory, if everybody tried to get their money at the same time and wanted a tangible dollar for the amount that reflected in their account, very few people would be made whole, probably less than 10%. That's how much over leveraged we are in terms of the U.S. banking system, but more importantly, the U.S. dollar currency abroad and domestically. Every transaction that once required lengthy interactions with clerks and advisors at financial institutions are being moved online. This is what I'm talking about, this whole automation, that the health crisis was a ideal situation, as the old saying goes, don't let a good crisis go to waste. I think that was the impetus to make some of these financial institutions change their models and thereby restricting the public's access to their own money, but hiding behind the cloak and dagger of it's a health crisis and this is why we have to limit it. Finally, cash is almost a thing of the past. The day when humans collected paper money and coins have come and gone. Most of us don't even carry cash. And I think this is something that's going to continue in the future. There's something that they talk about, a digital wallet or digital currency down the road. If that gets to that point where the government basically will be able to track every penny that you spend and what you have, there will be no more hiding places, to keep that in common language. Bank branches have several disadvantages for banks. Some are in the rented locations, often located in expensive areas. You go all the way down here. Just a bunch of malarkey. The largest banks have thousands of locations. Wells Fargo, for example, had 4,894 at the end of 2021. Bank of America had a little bit over 4,000. And these banks just have systematically started to reduce their net branch footprint. The Bloomberg story was based on an S&P Global Market Intelligence study titled U.S. Bank Branch Closures Increased 38% a record high in 2021. Now, this is a year after the health crisis. And since then, as you know, you just see less and less banks that are available. Wells Fargo shut down the most branches with a net total closing of 267 locations. The much smaller U.S. Bank Corp, they closed 257. So as a percentage base, since this is a smaller bank in terms of their national footprint, they almost closed just as many as Wells Fargo, which has a larger footprint. So this article goes on and on. I'm not going to beat this to a dead horse. I think you get the point. But here's the point I want to transition when I started to say at the beginning of the video, is it really your money? Here's the deal. When you make a deposit into your financial institution, at the time that money hits your account, you are an unsecured creditor. It's actually a liability for the bank. It's not your money. Let me repeat that. Once your money goes into a financial institution, even though you see those little digits on your phone, or if you get a receipt, if you're doing it in person and you makes you feel good, that's technically not your money. And if you don't believe me, trust me, it's true. I'm gonna talk about this bail-in at the end of this video. I'm gonna prove that. But more importantly, if you have a decent amount or a sizable amount of money in the bank, go into the bank and just say, hey, I like to take out $5,000 or $4,000. And the bank may say something like, we don't have that much cash on hand, or you're going to have to fill out a form and come back in a couple of days, or we're going to have to clear this within 72 hours. Well, in theory, if you're making a deposit into a bank and you go in there to get your money, why would you have to wait? There's something that used to be called fractional banking, which basically means like for every $100 that you would give a bank, they might loan $10,000 out on every 100. Well, they removed fractional banking about, I think, a year ago, which basically means in layman's terms, the financial institutions are not required to keep any money on deposit in relationship to the amount of money that they take in. Some kind of check and balance system that was removed over a year ago. And since then, these banks have gone crazy. These banks are flushed with cash. They don't want the money. That's why you folks aren't getting anything but a paltry return on your checking or savings account. You can have $10, $15, $20,000, $30, $40, $50,000 in a checking and savings account, and you can't even get 1 or 2%. It's just laughable. But let me get into this bail-in because I want to spend a little bit of time on that. And it's quite interesting article because, like I said, a lot of people are just not familiar with this. And this is basically a way for the bank to legally steal your money. So let me see if I can go here and change my screen here. And okay. Hang there with me, son. Hang in there with me, son. All right. There we are. Okay. Okay. All right. Sorry about that. A little technical difficulties, but we're going to make it through. All right. So here we go. Here's the granddaddy. Why bank bail-ins will be the new bailouts. Okay, so let me set this up for you guys. The financial crisis in 2008 ushered in terms of too big to fail. So I'm not going to read this verbatim, but basically what happened in 2008, the banks were over leveraged because they had toxic mortgages and they mismanaged the mortgage business, the mortgage industry, so to speak. And as a result of that, we had a basically financial collapse. So the taxpayers in 2008 were on the hook for all of that money, all of that mismanaged money, that's a tongue twister, that the banks were responsible for. So they made the taxpayers bail out the banks for their own mistakes. So they said, wait, hold up a minute. We can't let that happen to the taxpayers. We don't want to do that. We can't let these banks continue to fail in the future only to default back to getting the money from the taxpayers. So what happened, Congress passed the Dodd-Frank Wall Street Reform and Consumer Act of January 2010, which eliminated the option of bank bailouts, but opened the door for bank bail-ins. Not out, in. So now we're going to get into the meat of this definition. A bail-in and a bailout are both designed to prevent the complete collapse of a failing bank. Okay, ideally, the bailout is when the taxpayers bail out the financial institutions like they did in 2008. The bail in, the banks use the money of its, here we go, drum roll. What they bank bail in, the bank uses the money of its unsecured creditors. That's you, including depositors and bondholders, to restructure their capital so it can stay afloat. In effect, the bank is allowed to convert its debt into an equity for the purpose of increasing capital requirements. A bank can undergo a bail-in and quickly through a resolution proceeding, which provides immediate relief to the bank. Okay. The obvious risk to bank depositors is the possibility of losing a portion of their deposit. So let me give you the layman terms for that. If a bank's getting ready to default, they're going to convert the whatever amount of money that you have in the bank and make you a shareholder. But what's the value of having shares in a failing bank? I hope that's resonating. Now, some of you think, oh, well, hey, Kevin, I'm cool because I've got less than $250,000, or that's what was purported to be a safe haven amount. If you have $250,000 in the bank or less, then you're covered by FDIC, the Federal Deposit Insurance Corporation. I'm not going to spend a lot of time on that, but I'll save you the time of doing the research. That entity, that government entity that's supposed to protect those depositors that have $250,000 in an account or below, $250,000 or below, is covered by FDI insured. As long as that financial institution is FDI insured, that entity, FDIC, is bankrupt. FDIC is bankrupt. They cannot make you whole. So please don't be under the misconception that I'm okay if I've got $30,000 or $40,000 and then the system collapsed because the FDIC is going to make me whole up to $250,000. You ain't going to get anything, homie. And definitely the people who have over $250,000 are not going to get anything. Unsecured creditors, depositors, and bondholders are subordinate to derivative claims. Derivatives are the investment that banks make among each other, which are supposed to be used to hedge their portfolio. Okay, that's in essence what that is all about. Once again, the provision for the bail-in in the Dodd-Frank Act was largely mirrored after the cross-border framework and requirements set forth. And this is getting all into some stuff that you guys don't need to know about. So what can you do to mitigate or reduce your losses? There's no way to hide. You're going to have to keep some money in the banking system. Some people are advocates of just getting out of the banking system altogether. I think you need to diversify your assets a little bit. In my humble opinion, switch my screen down here. In my humble opinion, here's where I'm at with this. If you have to keep some money in the bank, use a credit union. I've talked about this before. They don't get involved in crazy leveraging. They don't have a lot of toxic mortgages. Some of them maybe don't even do that many mortgages. You want to do your own research and find a local credit union that's financially solvent, that's been around for a good period of time. Your money's much safer in a credit union than in a big financial institution like, Bank of America, Wells Fargo, JP Morgan, things of that nature. So that's one thing you can do. There's some people that are converting all of their extra cash to Bitcoin, which is a digital currency. I'm okay with that. I invest in cryptocurrencies. I have a decent amount in that, but that's not where I have all my bread and butter, so to speak. So you gotta kind of diversify a little bit. You guys know I'm a big advocate of gold and silver, which is a good hedge against inflation, and silver is doing quite well. I still made a large purchase, like I said, back in 2017, and got quite a bit of silver, and I only paid $17 an ounce. And I think silver right now it's around $25 or $26. That's the price. If you get it from a dealer online, you're probably going to pay $28 or $29 for that, or maybe even $30 for silver. I haven't checked, but I hope you found this article in a good place. My motto, please keep your credit score up and keep your debt down. If you're enjoying this type of content, please do me a wonderful favor. Please subscribe, comment, and share because I care. If you watch the video, just take 1 second and click the like button. Help a brother out. But all jokes aside, this is very important information. Please understand that your money's not your money once you put it into the bank account. And if you're still not convinced about this information, think about it this way, and then I'll close out the video. you can't necessarily get your money. Remember, I gave you the example. Try to go into your bank and ask for $5,000, and they're going to tell you it takes a couple days for you to get it, or they'll flat out tell you they don't have that much hard currency in the bank. Let you owe money to a debt for a debt. And then all of a sudden, that debtor, let's say ABC creditor, gets a garnishment approved by the court for $5,000 against you. Guess what? The bank will allow them to go in there and then electronically transfer that money out of your account to satisfy a debt. But if you're going in there to get your own money, now all of a sudden you have to go through these protocols and these procedures to get your money. So if that isn't proof, I don't know what else is. Thank you for spending a little time with me. Once again, hit that like button and comment. This was the Kevin Strong Show, and I'll see you in the next video.